Hello traders, welcome to FreeFX. I'm Francesco. Today we're going to discuss a lot of things. It's the start of the week. There's no Labor Day holiday in the US today, so we've had a bit of price action that's worth actually discussing. And we're going to talk about the S&P 500 as SPX. So my first thesis is that we have a few things happening this week, which I discussed on Friday, so I won't go over that again. But the main one is the CPI numbers, and it's a blackout period for the Federal Reserve because of the rate decision next week. So we won't get all the speakers that we got last week, and that means that we don't have any sort of rhetoric to kind of back or trying to push back on market moves. Therefore, what we have is price and speculation about things like inflation, what the Fed might do next week. But get this, price today has been a little bit different from what we had maybe end of last week, because we come to some kind of interesting technical points, and let's go into it then. So we're going to try with this, which is the S&P 500 daily. You can see very clearly that the VIX in purple here has started to creep up again, and we sort of dipped a little bit last week because we've had now, if you count, it's actually quite a few candles on the green side. 1, 2, 3, 4. 4 green days on the S&P, okay? And obviously, you know, there's a lot of ground to recover from the fall we've seen recently, and from the fall we've seen in January, to be fair. And we have a lot of ground to recover, but that's your January there. But we are certainly not gaining momentum on the downside, which, you know, alarm bells if you are short like me, more than once. And the other thing is that the ATR has sort of dipped back to that 70 level, and we're just really wanting to see that develop a little bit more. We're just at 71.7, so we're just above. But we're still above it, and the VIX is sort of still above 20, which is kind of my benchmark, if you like. And so that means that we have room to grow in terms of the downtrend. Now, technically speaking, this is quite interesting, because if I just take off this add CCI, we will get to my next point. So this is the technical analysis side of what we're seeing, but there's a fundamental side as well, which is the inflation figures tomorrow, speaking to the side of the markets, or the side of money floating around in this index, which wants to kind of get back into basically buying and holding and getting onto the next rung of the upward ladder. I'm trying to avoid the words bullish and bearish because I'm really tired of hearing these bandied around constantly as if it's some kind of magical contrast between two people or groups of people. It's not really as simple as that. It's very simplistic. I think it's for the news headlines, but it's not really. So I'm going to talk about uptrends, downtrends, or uptick, etc., or downtick. Let's cut out the bullish and bearish in terms of markets, etc. So it's not really about money trying to push price up so much. I think it's really, these are technical moves at the moment, and I'll show you why in a second. I think that is. So the CCI as is not the right setting for me, because I always have it as a 21, and I always have it as well as that as a 200 negative and 200 positive. Why? Because, as I said before, it's a filter. So the 100 is actually visited a lot more than the 200, and so for that reason, what we're using the indicator for, we already have the Bollinger Bands, we have other things as well, but this is really to look at extremes and bounces from there. So we're just coming out to the 0 level, and the 0 level is very important for us because it gives us a perspective on things and that means that we are potentially at a 50-50 crossroads. We can go one way or the other. It's neither nor. It's not, as people say, a done deal that we're going to continue higher, nor is it a done deal that we're going to continue lower. So let's kind of get that straight. And once we have that, I think we are going to be best friends. Now that's really a better deal than trying to sort of divine what is going to happen. So that is what we need to see to kind of really read this properly, and I'm going to just make this a little bit easier to see with that. Potentially it's going to be really easy to see. How's that? Okay, so you can see better now where we are. We're just coming to the 0 level there, and with price, if I take the VIX out so we can see a little bit better what is going on here. So you see the basis from the Bollinger Bands have a sort of mean reversion point, and that's your 20 simple moving average, 20 SMA, and that's what you see in there in amber. Price has peaked above that, yes, but that's the closest today has been above that. We need to see what happens tomorrow. We'll open above, obviously, and yes, it might continue higher, or it might fall. And the CPI figures are released in the afternoon UK time, and so we need to see what happens in the morning in anticipation of that. A lot of people are watching that, obviously, you know, retail traders like myself, a lot of people on Twitter are talking about it. So, and then obviously people who manage, you know, large sums of money will be watching that as well. But in the end, what happens, nobody knows. Technically speaking, although we sort of peaked and just broken above that 20 SMA, the CCI is actually just got to the 0, which is neutral. So it could literally happen that just like here in June, end of June, we got to that point, we just broke above it by a few points, and then the CCI just basically bounced off the 0 or neutral line and then lower for a little bit anyway, and then again, so that there was no conviction here end of June, beginning of July. Then we had the bear market rally, so called. Before that, if you want to find examples of what happens when we are trending and we go onto that 0 level, so when we had the downtrend from January, we came up to the 0, peaked above it, and then returned lower, went near 0, returned lower, went above it, and then again. So these are not really at 0, they're just kind of a little bit below, quite a bit below actually. We're talking minus 60. So, you know, it's a very particular thing to get to almost exactly 0, because that usually is like a turning point, and it's a very important point unless we cross it. If we cross it straight away, like here back in March, you can see the crossing there is straight away a sign of things to come. So looking at the at this, you can see that we have something a little bit particular, and that is the volume. So look at the volume declining throughout this section of price. So from the 8th of September, the 8th of September, just to remind you, was last Thursday. So from Thursday, we had this behavior. Okay, so today the volume was much smaller than we've seen. If I just try to squeeze that a little bit, now you can see volume clearly declining throughout sort of end of last week, beginning of this week. So we have declining volume, and I showed you the OBV, on balance volume, declining as well last week on Friday. We have uncertainty about, you know, a move higher. Where does that go? We've got quantitative tightening coming in bigger and bigger chunks, taking money out, liquidity out of the market, trying to sort of douse the flames. So we got all these things working against sustainable growth in an index like this, 500 or more, depending on how it fluctuates, of the largest companies in the US. Now, the way I work this is that there are many ways to look at something, and you can come to slightly different conclusions. So I try to follow the same kind of trail of thought and basically look for clues that a particular view is still applicable, which is very difficult to do. But there are different ways that you can look at a theory. So one of them is to look at as many variables that can help to look at angles or points of view. For example, if we look at, as we've done before, the options heat map, that will give you a sense of where the options market, which is based on the S&P, the options market based on the S&P, which then gives you the VIX volatility. So the options market based on the E-mini futures, which is what we're looking at here, might give you a clue as to where the biggest changes in terms of orders is in relation to price. And we've looked at that many times. We're not going to look at it today, but just to say you can follow that line all the way, and sometimes it will not really give you an edge, and sometimes it might, because it's very changeable. So you have to kind of keep up with the changes and see how that relates to price. Another way is to look at volume, on balance volume, actual volume bars like here, and see change rather than absolute numbers. And again, it builds a picture. It builds a picture. So today and Friday, there's no holiday, there was no nothing, and yet volume is declining on the S&P futures. Another thing to remember is that we come into the end of September, so these contracts are going to expire. So to be fair, what we need to do is go into the December contracts and have a look at volume there to see if there's any difference in the way volume is looking on the December contracts. So that's the December contracts. If I look at the hourly, okay. So on the December contracts, we are looking at something a little bit different. So I'm just going to open that and see if I can open that as well. Okay, I have to open them sort of one after the other, but if you can remember that we had on the December contracts, these last 2 days, so Friday and today, were quite large in volume. So again, another thing to look at there is that we have the declining volume on the September contracts, but actually the December contracts volume is quite sustained. So again, it's a different way of looking at it when you're looking at two separate contracts. So which one do you trust? The September contracts are not expired yet. Another thing as well is the quadruple witching, so the expiry of options, index options, and two other categories of contracts. And this is quite important because it sort of there's sort of orders to fill, and basically there's rebalancing of portfolios, etc. So this happens every quarter. We've had it in March, we had it in June, so end of September is coming. I don't know the exact dates, but saying that's going to come. And we've got the FOMC rate decision next week on Wednesday. So from then on, we have a lot happening. Historically, September has been a down month for the S&P 500. Down meaning moving down. Obviously, it's not down if you're trading that short. So we are halfway through the month, almost, and we need to see the next couple of weeks really something developing here, because it's struggling to either maintain the downtrend or start on a new uptrend. It's really not committing to either. And we've had all the confirmation that the Fed are going to raise rates by 75 basis points, so there's not really anything there that... So without further ado, let's just kind of close that for a second. So a curious mind and looking at different angles on things. So if we went back to our chart here, for example, we talked about so we're just starting a new day. As you can see, it's just making a little small candle there. That's the 11 o'clock, so Data is going to come in any second now. And so that's the CCI for the daily, but if I went to the 4-hour, for example, I've mentioned this on Twitter, and we have this CCI declining. Okay, I've mentioned this as well on the video, on Friday, that this CCI is looking very suspicious. And the way it's looking suspicious is that while price is rising, CCI has now flatlined almost, or even dipped from the 8th. So from last Thursday, we've had 3 full days now, Thursday, Friday and Monday, 3 trading days of decline. If you don't believe me, all I need to do is do a little trend line like this, okay, and just draw it here. Okay, you can see what I'm talking about. It's just doing, okay, it's just basically going opposite price, and that's 3 full trading days of the flatlining stroke declining CCI versus price rising. Who's going to win? Price? Is the CCI going to follow price, or is price going to kind of come to its senses? And yes, there's a problem here. Houston, we have a problem. You know, there's obviously something, a disconnect there, and that usually resolves itself. In a strong trending market, the CCI can diverge, but then it will follow price. It will keep diverging, because it has to rebalance, etc. In a non-trending environment like this, because we're not really trending, we have these stronger divergences, which should be listened to. And I've given examples before of when that works, and it can't really be a predictor, if you like. But that's really neither here nor there. We just need to see a resolution to that. Okay. Now, the other thing I was going to say was, why is that not a trending environment? The reason why it's not a trending environment, I'll show you in a second. And this is what I mean by a curious mind. Check through different time frames, see how things look wider. So if you zoom out, like here, for example, you'll be able to see that we are not, on the weekly, we've sort of gone above the basis there, and above the 21 moving average. If I can just take the moving average, 21 weighted moving average out. So we are above, and the next thing we're going to look at is the monthly, and start from there. So work your way down. So on the monthly, we now have the 4th month, and what I mean by range is that effectively, if you look at that, we've had 2 months. Yes, June and July have basically topped at this price level, okay, which is 4101. So 4100 is this sort of price cap, if you like, that we've not managed to either fully leave behind, and we've not really managed to rise above. So 4100 has been a sort of constant cap for now 4 months. So 4 months of moving basically, and you can see the last 2 months, so August and this month, compared to the previous 2, June, July, which had wider candles. But essentially those 2 candles are, if we had something like a 2 monthly candle, it would be basically a doji, because those 2 candles, the June and July put together, basically cancel each other out. So there's no progress to the downside or the upside. Okay, we started up here, and the next month we finished up there again. So it's as though, you know, June and July, which, you know, people talked about the July bull trend and all this, and then we've had August, moved away from that. So June and July achieved nothing. Essentially, we started August in the same place where we closed May. Yeah. So we wasted a whole summer thinking about, you know, big moves, and it's not really gone anywhere. So what I'd like to say is it's very important to try and get a sense of proportion and look at the wider trend as well. The wider trend, if you look at the CCI, is that we are going down. Okay, that hasn't changed. And if we look at the, and we're not at extremes, by the way, because we've had bigger extremes than that to the downside. If you look at the weekly, it's rising. It's rising above the 0. So the weekly is looking like it's going to continue rising. The weekly does not agree with the monthly. Which one is right? And if we look at the daily, as I said, we come into the 0 level. Okay. We're just peeping above that. Okay. And if we look at the 4-hourly, again, as I said, flatlining. So we have these different readings from the 4-hourly to the daily to the weekly to the monthly. Very confusing to really see a clear sense of direction there. Okay. If we look at Twitter, there was something written about CPI, saying that basically Wall Street was guessing, sorry, that was something that fell, was guessing that the CPI was going to be coming in softer tomorrow. And my argument was that CPI or any data cannot be guessed, and the most kind of rational thing would be for markets to stay flat or neutral before a big data release. And sometimes we do see that. I can think of examples where there was basically, you know, a big announcement coming, and you see a lot of very, very small candles for, you know, for a few hours, waiting for that price. But today, for some reason, and indeed Friday and Thursday last week, and Wednesday, we've seen, for example, the S&P rising steadily with no actual certainty. So it could all unravel later this week, as we got CPI, the Michigan sentiment, consumer sentiment. We've got PPI as well. All these things are coming in, and they could all work against this particular move, and yet it's happened. So it's there. It's recorded on price forevermore. But if you look at what I talked about here, Michael Kramer from MOTT Capital Management, he talks about in his latest video Cleveland Federal Reserve Bank, and they have a very good predictor of inflation figures, CPI, and they've been pretty much on the money every time, and they're predicting a higher inflation tomorrow, not 8.1 but 8.3, I believe, and things like that. So, and then we've got, you know, core is predicted to be softer, and then main sort of headline inflation is going to be higher, but the Cleveland are saying is going to be higher. Then somebody answered this, and they said that, and I also posted here from the CMT. I'm on their sort of main list, the chartered market technicians, and they've put in something there saying that historical readings going back to 1950 show that the stock market has not reached a bottom as long as the S&P 500's monthly relative strength index is above 42. Goes to explain why. But the other thing, so that was my sort of article. The other thing that was mentioned was that let me just see. Yeah, somebody replied saying that well, I can't remember exactly. I think I might be able to find them here. Somebody put yeah, this article here. So this was from Credit Suisse, and Credit Suisse put an article, and the article was saying that we expect headline inflation to fall 0.2% month on month, the forecast, and to 7.9, so even lower than what the consensus is, etc. So they've got this CPI and core CPI projections, which are even softer. So that's Credit Suisse. So who do you believe? And so you can look at a number of these. I mean, if you had all day, and one more thing that I haven't certainly done, and I'd probably like to do, you could take, if you really care about these announcements, you could take all the CPI data points, and then basically calculate the market response on a particular instrument. For example, the S&P, the Nasdaq, triple Qs, and you can check the Russell 2000. You could check the Dow Jones Industrial Average. You could check the FTSE 100, whatever. Take an instrument, or do it with stocks or forex, etc., and then calculate the move when the data is released. If the data is released at 1:30 European time, then you're going to wait another hour for the US market to open. So you then maybe decide that you actually calculate it not from the release point, but from when the market opens in the US, and take it from there. And then decide, the move an hour after the data, 4 hours, and maybe to the end of the trading day. And then see how that, put it into a percentage, how that relates to the change, whether to the upside or the downside, or how much it beats the predicted figures, consensus figure, and by how much to the downside or the upside. So you could do that study. I haven't done it, and I won't be doing it because it's just well beyond what I can do in terms of time. But that would be the proper way to assess predicting CPI and expectations of market movements, by doing a lot of data points and studying through the reactions of. Not that it can predict something, but it certainly gives you a better probability of understanding how markets may react, if you want, or to what degree or how much. But like this, it's every maybe analyst or bank blog post or publication will come up with its own projections, and the Cleveland is saying one thing, and the Credit Suisse is saying something else. So clearly they can't all be right. So some will end up being wrong, some may be right in principle, but then price goes irrational, and so we won't worry too much about that. But you can see that there's a way of thinking about this. So this week, my next video is going to be on a Friday, and I'm hoping that this week there's going to be a resolution to this impasse between the presumed sort of doom and gloom, and the presumed jolliness and happiness. These two kind of forces, which at the moment are very, as I've shown you on the monthly chart, are very conflicted. And there's not been much progress with the 4100 level there acting as a cap. And for that reason, we can't really say that we progressed anywhere in the last. We're just peeping above 4100 as I'm saying this. You can see 4100 was down here. Okay, so we just peeped above that, and that's just happened in the last few hours. So we need to see what happens next. So my point with all that is we have a very important week. John Kicklighter has always posted this graph showing for a few decades the S&P 500 performance. In September there's more volume, so more activity, and also a lot more losses in terms of, if you're a long only holder of an index, it would be a down month usually. And as I showed you before as well on another site, February is usually a bad month as well. February, September, October. So you have to see how we go with this, but these are kind of averages from long periods. But even so, bear in mind that this is going to be, and the stress is on bear, but I said I wouldn't use that word, so I'm not going to. It's going to be on what happens in the next few days. And it seems strange, but that's exactly true. So without further ado, I will wish you a very good week, and I will see you on Friday. If I can, of course, I'll do another video midweek, but so far I'm sticking to 2 videos a week, so my next video on Friday. hopefully we'll wrap up the week and we'll be able to see some progress in that. So take care and see you in my next video.